All right, so I just want to get started if I can. We are waiting for one other presenter, Jordon. Jordon's done. Anybody know Jordon Scrinko? Anybody? No? All right. Well, hopefully he'll be able to make it on. So I want to thank everybody for joining us today. We do have other folks that will be joining us. I just don't want to start too late. But I want to welcome you to this great city's real estate investment seminar, and I'm really happy to have Araceli, of course, Hernandez. Araceli, do you want to just introduce yourself?
Sure. I was going to do it when I'm presenting, but my name is Araceli, and I'm a transition financial specialist and also a real estate investor. And I invest in Canada and in the US mainly now. So I will talk about it later. Thank you.
Awesome. And Randy, who's going to be our first speaker, if you can just introduce yourself really quickly.
Yeah, my name is Randy Dalton. Thank you, Yuriy, for inviting me to this, and appreciate the opportunity to chat. I'm a real estate investor as well. Real estate investor, property manager, contractor. Yeah, that's me.
Awesome. And then of course Yuriy.
Good morning, everyone. I'm also a real estate agent, real estate investor, a mortgage broker, a woodworker, a fisherman. I don't know what
else. Awesome. Okay. All right. So first, I'm just going to have Randy Dalton just start off by doing your 10-minute presentation. What we'll do is we'll have Randy start. Araceli will follow, unless Jordon joins us, we're going to have Yuriy take Jordon's spot. So go ahead, Randy.
Okay. Yeah, thank you for the opportunity. Appreciate this opportunity to be able to talk to everybody. I wasn't sure the audience. I wasn't sure if everybody's a real estate investor or what. So Yuriy asked me to talk. I thought I would just talk a little bit about property management. And I put together just a very generic slide with regards to property management services. So if anybody is out there, if you are a real estate investor, if you're thinking about, should I hire a property manager? What kind of person should I be looking for? What questions should I be asking? That's what this presentation is about. And I'm just gonna, if I can, I'm gonna share my screen and just go through it. I lose my clock when I do this, so if you can just cut me off at 10 minutes, I'd be grateful.
And starting now.
Oh, okay. I got a couple of minutes for free there.
Right.
Yeah, so let me just hopefully everybody's can everybody see my screen?
Yes.
Yes?
Yep.
Let's try it. There we go. Okay. So a couple of things that you want to look for if you're thinking about hiring a property manager. Number one, experience. They say it takes about 10,000 hours to create an expert. 10,000 hours. What does that represent? The average person works about 2,000 hours a year. So to get to 10,000 hours, that's 5 years. It takes 5 years to build an expert. So one thing that you want to be talking about if you're thinking about hiring a property manager, how long have you been in the business? If they've been in the business for a few months or a few years, it might sound like a lot, but it's really nothing. And one thing you really want to think about when you're hiring a property manager, if you're going to do that, you're going to go down that road, you really want expertise. You really want an expert beside you to help you go through some of the issues and problems and potholes that you might run into. Another thing to think about is depth of resources. A property manager wears many hats. And when you are self-managing or you're hiring a property manager and they're one person, you got to think about the fact that they have to do all of your accounting, all of your bookkeeping, they have to manage your trades, they have to sell in order to find tenants, they have to deal with tenants and people from the city and neighbors. I never realized when I first got into property management how everybody asks, what's the biggest skill? The biggest skill is relationship management. The biggest skill is relationship management and what that takes. So when you're looking for a property manager, you want to look for someone that's not just an individual, but actually has a team, a large staff of people that are wearing those different hats, not one person wearing them all, but 4 or 5 people each wearing one hat. One thing that property managers do for you is emergency calls. And again, this is able to take those calls 24/7. When there is an emergency, and I can guarantee this, I don't know how it happens, but it never happens Monday morning at 9 a.m. When we get a break in the plumbing, if we get a call because the furnace is down, it is always happens Friday night or Saturday night. I don't know how. Yuri's shaking his head. He gets it. So you want to make sure you're dealing with someone that's not. Sorry, Yuriy.
Sorry to interrupt, but furnace breaks when it's minus 25.
Yeah, well, it never breaks at plus 25. Or if it does, you don't know. A property manager should be able to provide you with cost savings. You know, a property manager is charging a fee, but a lot of that fee is actually comes back to you in terms of cost savings. A good property manager should be able to work with trades, put them under contract, and put them under contract at preferred rates. So we've got plumbers, electricians, architects that all are under contract that can provide their services at a substantially reduced rate. Suppliers is another one. A good property manager, if they're large enough, they're going to be able to deal with people like Home Depot, Lowe's, Herman's, and be able to negotiate much better deals for you. Just as an example, we save, we're in a special program with Lowe's, we save anywhere from 5 to 25%. If you need drywall delivered on site, we normally buying drywall for about 11 to 12% discount. So that's a big savings for people. Another thing is insurance. Relationship management, I mentioned this. Totally surprised that this was as big as it was. Big question to ask a property manager is how many doors are you managing? And how many clients do you have? And how many full-time staff you've got? And do the division, right? If you're talking to somebody that's got 100 doors and maybe they've got 20 clients and they're all by themselves, they're managing 120 relationships. Do you really think they're going to be able to do a good job for you? Our ratios are usually in the 40 to 50 range, just to give you an example. So good question to ask if you're thinking about that. Property management software. This is a big one. There are systems out there, automated systems, that allow us to do virtually anything and everything. From collecting rents, it's a click of a mouse. Paying bills, it's all done electronic. Even service requests, they all come in online and they're all dealt with online. Now that online access is being able to, we're able to provide that to the owners, to the clients. So you've got a, not only can you go into our systems and have a look at everything that's going on, you can go look and see, okay, there's a service. Remember I said I'm in Vineland, I'm up on top of the mountain, I'm out in the country. I do not have coax cable coming into my property or fiber optic. It is line of sight, and if the wind blows the trees, sometimes we lose our signal. So I do apologize about that. Am I out of time?
You still have like 2 minutes on your time, so carry on.
Okay, I'm just going to share the screen again, go back to this. So as I was saying, all of those eyes are looking or should be looking at your property in terms of how to maximize positive cash flow, how to minimize expenses. Again, it comes back to those negotiations.
Well, you know, I mean, hopefully we'll be able to get some questions answered, because I do have a few questions for him. Like, what's the minimum number of doors? Like, do you have to have 10 doors, or what if you just have 1 door? What if you have a property and you just like a property manager to look after?
For what? Sorry, I can answer that.
for a property.
Issues
Like
with trades, with suppliers.
I buy a condo.
I mentioned insurance to try to bring your costs down.
This is going to take some editing.
I think, Ivan, the answer is blowing in the wind.
Yeah, I think so. I think so. You're back. Okay, you know what? So, Randy, I've got a few questions for you that I'm going to ask you after. And hopefully, we'll be able to get the rest of the information from you because I'm very interested in hearing more. All right. So, Araceli, can you? Are you able to?
Oh, hi.
Hi.
There you go. Let me just share my screen. Can you see my screen?
Yes.
I have a few slides, and I don't, the same thing. I didn't know who the audience was, so I'm just gonna go in very general terms of who I am, what I do, and why I got started in the US. So my name is Araceli, transition financial specialist, and I grew up in Mexico. I've been here in Canada for over 25 years. I have a mechanical engineering degree, and I work in the industry for 20 years. And what happened to me is I got divorced, and everything fell apart after that, and in terms of finances. And that drove me to kind of understand more. I really thought that it was because I was immigrant that I didn't know the system. But in fact, I realized that a lot of people don't really know about finances. And the more I studied finances, the common theme came about that every rich person that I met had real estate. And I said, oh, wait a second. This is a common theme. So what can I do now that I'm single, that I only have one income and that I don't have a lot of income? So what can I do? So one of the things that I did is I bought a property in Hamilton. And this is basically my why. Why I wanted to go into real estate is to provide positive cash flow and supplement my income. I didn't know if I was going to get remarried or meet somebody for all that. You know, I couldn't really count on it. I already had the experience, and a lot of people are getting divorced, and you don't know if another person will come along. So this was the reason why. So this is how I got started. This is my property in Hamilton. And I bought a single family home that it was already a duplex. It was already converted. And what I did is I took the basement and I added another unit. So I have a triplex now fully working. So I bought it in 2014. So just before the market started to pick up. So these are my numbers. And so what I did is I bought this property for $182,000. I put $88,000 all reno, so my total was $270,000. You know, now this is unbelievable. I actually just renewed my mortgage, and the property was appraised at $470,000 just at the end of 2019. So it's like shy of 5 years when I bought it, and my gross rent is $3,000. So I didn't know anything at all when I wanted. The only thing I wanted is I wanted to have something that would give me some cash flow. And I did it. And I started to look at the numbers and I started to study more. I went to different seminars because I wanted to learn more about what I was doing. So what I learned is something that I just always go by. And this is the rule of 1%. And this is basically how I buy real estate. So the rule 1% says that my purchase price plus my improvements, in this case, I'm just gonna, for easy numbers, 100,000, has to equal my gross rent, which it has to be $1,000. So I know some of these numbers are not very feasible right now in Canada at all, but these are kind of the numbers that I learned. And if I go back to this, when you look at it, I did it. I didn't know how I did it. I just knew that I wanted to have some money coming in that would cover all my expenses. So if you see with all my rentals, I had $270,000 and my gross rent was $3,000, which by the rule of 1%, I was perfectly on track. And I didn't know how I did it. I learned the rule after. But basically that's what I have to give you today. And the second thing is, this is the step plan. If you're not an investor, this is what I would recommend for people to do, right? Very, very simple. First of all, is understand your current financial situation, right? And I won't not go into a lot of detail on it, but there's basically different stages that you are in, and each one of them will have a strategy for you to get started in real estate. And the reason that I say that is because when I started in real estate, I did not have a lot of money. And a lot of people would like to get started, but don't have a lot of money. So, and in Ontario, we require quite a bit of money right now to get started. So the second thing is you need to choose a strategy and a target market. So this is very, very important because there's many different strategies. You cannot just become a real estate investor. You need to become, like, what do you want to do? Do you want to do flips? Do you want to do rentals? Do you want to do rent to own? What do you want to do? And also pick the target market. If somebody tells you that they're an investor, but they invest all over the US, please run away because it's not possible. It takes a very long time to figure out a market, to really kind of narrow down into the details of the area, the neighborhoods, and what is the economy, how you're going to be working on it. And step 3 is very simple. Just commit to the plan and just be consistent. So the dream, plan, and do. It sounds very simple, but you really have to decide, plant your flag, and this is where you're going to get started and go at it, learn. The next thing is, let me tell you about it, the US and why I decided to go there. So why the US? The US market is very, very different from the Canadian market. We have a large number of foreclosures there. And the way that foreclosures are sold in the US is not the same that they're sold in Canada. In Canada, by law, you need to sell it at a fair market value. In the US, the foreclosure is whatever the city decides to sell it at. In some cases, when it is a tax auction, you will only pay the taxes and you get a property that is worth $100,000 for $6,000, $10,000 that is owed in the taxes. And that is something that now you can start getting into real profit because you're acquiring the property quite low, which is in Canada is very, very difficult. So obviously we have many undervalued areas, areas that now are starting to get gentrification, and they're still at a very low price and you can get really good deals. So their investor opportunity is because of lower value, so you can buy more than you can in Canada. The property will have positive cash flow very quickly, including all expenses. And the purchase and investment property in Canada is more difficult. As you've seen, and probably Yuriy can say better than me, what are the requirements to get a second property here in Canada. It's a little bit harder than it is. Now, this is one of the things that most people ask me, and I'm gonna answer the question before you ask, right? What about the income taxes? And by the way, I do have a free document that it has all the most frequently asked questions about the US investments. So if you want it, I'm gonna give you my information at the end, and you can send me an email and I can send you the document for sure. So income taxes. So as a Canadian, yes, you are able to buy a property and you can buy it either on your name or on an LLC to protect your privacy and limit your liability. We can show you depending on what strategy you are looking for. So you have to file taxes here in the US only the first year after you acquire your first property. And the reason is because you don't have a business yet. So what they do is you go the first year, and then on the second year, now you have something to report. You have to do your taxes, and now you will file with the IRS. So if you do have to pay taxes, which if you get started, normally first year or second year, you probably won't have to pay because you have the expense to get in. But if you do pay taxes, then you do pay your taxes there, and you bring your taxes, your tax return, the US tax return, and you give it to your Canadian accountant, and they will have a credit for what you pay if you do pay. So there is no double taxation. So that is one of the biggest, the number one question that everybody asks. So I wanted to answer it before you ask. And of course, if you have any other questions, for sure, I will answer those. But this is, I just put this slide very quickly. I deal directly only with Ohio. I do not buy anywhere else. These are the pros. So very low investment capital is required. It's a 4.5-hour drive from Toronto, which is not that far if you are considered to buying in Barrie or any other place far away. The landlord-tenant laws are favorable to landlords. So that is one of the things that I like the best. We do have property management in place, and we understand how important it is to have that, because you need to have eyes all the time on the property. We have accounting and legal advice available as well. And the rate of return in each property would be between 8 to 10%. That's very typical with the buy and hold. Now the cons, obviously. So we do have a steady appreciation, but it's not comparable with Toronto. You're not gonna get the 10% or 12% or 20% that sometimes we have got here in Toronto, but we do have a steady appreciation of 3-4%, which is normal for real estate. There is no financing available yet, at least in Ohio for now. In general, properties are older. If you are familiar with Hamilton, Hamilton has houses, 100 years old plus. So those are the kind of properties that you will get. Now, Ohio is starting to get some areas where you have newer construction, and those are really nice areas. So, and the cons is 4.5 hours drives. If you don't want to drive, you want to do it in your backyard, it's probably not for you. But those are the things that I found that I can relate to you. Another thing is, I'm just going to give you an example, and this is a property that I bought in 2016. That was one of my first properties. So I bought the property for $20,000, actually a little bit under $20,000. And the repairs that I need to put in was $20,000, and this is US dollars. So my total investment was $40,000. The rent that I was getting at the time was $730, and I factor all of these in. And some of these things in Canada, some people that want to get you into real estate investing don't factor the vacancy rate. They don't factor a lot of things, property management sometimes. And I think that is incorrect. You need to factor that in because that expense is there no matter what. And if you can see with this one, with all the deductions, my net revenue in this case was $272.60 per month, and which it provided an 8.2% return. Now, if I was going to do something like this, now remember this was done in 2016, just to compare apples to apples. A property that was bought for $275 and just needed a minor repair, needed $55,000 for down payment. This is the rent that you might get, $1,800, and all of the deductions. And if you can see after this, because you have a large mortgage to pay, the revenue would be in the negative. So that was one of the things that I did not want it to do, even if I wanted to take $100 a month, but it should be positive, because my question is, sometimes you may be able to do one property at a loss because, in Canada, we get pretty good appreciation. And if you can do it, it's fine. But how many of those can you do at a loss? While if you have one that is giving you $100 positive, you can have 10, 20, whatever, because you are not losing money. So that is also a financial decision, because if your income varies or you have two incomes in the house and one of them stops, especially now with all this thing happening with COVID, a lot of people are either not working, they're laid off, they're losing their job. It's a lot more difficult. So I wanted to be kind of on the safe side. And that was the main reason that I decided to go to the US, because I could not buy a property like I could buy in Hamilton back in the 2014. I wish I could, I wish I bought 5 properties at that time, but you can always go by what you can do at the time. So that's it. So this is another property. This is the one that is, we just acquired, and it is waiting for us to go. If you see, this doesn't look like much, but this house is actually very, very big. It's 2,700 square feet. It's a duplex. It's a legal duplex. And we just acquired in December, and we're waiting to go back, and we're hoping the border opens as soon as possible. But you can see the acquisition was at $35,000. We expect the repairs to be about 125 because of the materials. We have about 47 windows to change, and there is big units to do. And we also want to finish the attic, which is really big, which we're gonna convert into another unit. But for 2 units at 850, which is for this area, it'll give us $1,700 gross to rent. And if you can see the investment versus the gross rent, it still needs my 1%, which I always try to meet when I buy a property. This is another property that was just recently sold. It's a single family home. It was rented at the time that it was sold. It was sold for $99,500. And there was a couple of repairs that the landlord did, the owner did before it was passed on. So the total investment was $99,500, has 1 unit, and the rent gross is $1,034. So the same thing, the same rule applies. So it meets my requirement. So that is all I want. I don't want to take any more than the 10 minutes allowed it, but I do want to give you, oh, sorry.
Would you, you would definitely not invest in Michigan?
In Michigan?
Yeah.
The thing is, you got to get to know the market. It's not that I wouldn't invest, it's that I need to go and do the same analysis that I did. My business partner and I went there, and we spent over 7 months going pretty much every weekend to look at the neighborhoods. Because you know what, if you look at things online, on Google Maps or Google Earth, it's not the same. Believe me, it's not the same. And sometimes those pictures are 2 years old. It will not give you the right idea. You do have to be there. I do believe that real estate, you have to really touch it, see the neighborhood, what is happening right now, because you don't know. Okay. Right? So what I invest, there is a ton of opportunities in the US in many different neighborhoods, many different states, but you have to do your due diligence.
Okay.
So you really do have to invest there. So
well, I'd love to hear more about that. We have to move on to Yuriy, but we'll come back because I have some questions. I'm sure.
Yeah, if we do have some time at the end. If not, this is my information. You can always give me a call, and we can have a chat about if you have any other questions at all. But thank you very much.
Yes, I like the low cost of entry into the American market. That's amazing. All right, Yuriy.
I'm not gonna bore you with a presentation. You're just gonna hear it in my lovely voice.
We love your lovely voice.
And it's kind of tough to follow up with something different, I guess, after a great presentation by Araceli and Randy. I'm gonna probably repeat what they've said in several times, but when you want to get into investing and not just kind of as a let me try. You want to really make up your mind and say, okay, I'm going to do it. But before you do it, you also have to decide who's going to do it, because you can't do it yourself. Like Randy said, you have to have many hats, and you can't have many hats because sometimes you even have a full-time job or part-time job. So you need to think of a team like Randy, like lawyer, real estate agent, mortgage broker, insurance. Lots of people forget about insurance, and if you get into the investment properties and it's vacant, like Araceli, going in and it's vacant, you have to do the renovations. Not every insurance company will insure that property, so you got to keep those things in mind. So now you decided to buy. What strategy you using to buy? How are you going to go around and find that property? Like as a real estate agent, I might be a little bit biased because I have access to MLS and that kind of stuff. But Randy will tell me in Araceli that the best properties are not on MLS, and I agree with that. So you have to do your homework as well and find that particular properties, whether it's you're looking at the neglected front yard, the roof, some signs of basically neglect, and knocking on doors. Simple as that. And you would be surprised how many doors will open. And but what my point is to that is you want to buy a low. No secret there. You're making money when you buy. You're not making much money when you renovate. You're not making much money when you buying on MLS because you're going to be among 300,000 people that buying looking for the same one. Although I did, right now, last month I found about 15 properties that are under the market value, but they're all generated multiple offers. So, but still, 2 properties, I think. I took Ivan to one of those. That property sold for $805, believe it or not. And just to give you a perspective, that property is in Ancaster, 100 by 120 lot, 2,800 square feet. For comparison, townhouse down the road selling for $1 million. So just to give you an idea. So I think that property is sold for what, $200,000, $300,000 under the asking under the market value. But anyway, so that's the bottom line. You have to buy right. That's one of the things. So, and then again, identifying what kind of investment you want to get into. Like Araceli mentioned, there's flips, there is, we call it strategy, which is buy, renovate, refinance, and repeat, or what else is there? There's so many R's that you can see. And again, when you buy the property, you want to buy it right. Why you using financing, banks financing? Because you can leverage, and that's my kind of biggest thing why people want to get into the real estate investing. Because let's say you have $100,000. I'll pick on Araceli again. That you have $100,000, just a good number, and you invest $100,000, even at 10%, you're looking at $10,000 return, right? Now, if you put that $100,000 into property and you buy $500,000 property, and at 10%, that's $50,000. So that's that's a huge difference. They can leverage that as long as it cash flow. To be honest, 1% is kind of a not existent at this point in Canada. There are some, but I haven't seen the property. If you buy it for $500,000 and it generates 5,000. Income, it's a tough one. On the lower scale, I can see that on 200,000, you can see, and that's the other thing that Randy loves, that portion of it. We're going forcing appreciation, right? And Araceli, that's what you do as well. That you force appreciation, and that's where the biggest equity increase is, because by doing that renovation, you don't make money on renovation, but where you make money is improving the property value, right? So, but I mean, forcing appreciation is not just through that. It's let me guess, put in one of those tiny homes on the property, right, for the extra income as an additional unit, or creating 2-3 units at the same property. Of course, if the zoning allows, or you have to go through the zoning or minor variance and make sure that you're legal in a sense, because otherwise it will catch on with you eventually. And I've done it the hard way, and so the neighbors. The biggest thing is the neighbor going to call. Eventually, the neighbor going to call bylaw officer, and they're going to knock on the door, and you're going to have a lot of trouble explaining why you have three tenants versus you only should have one single family property. So there's all kind. It's you learn it with time, I guess. And like Randy said, it's good to have the property management company. Good to have professionals all around. They'll tell you, and it's at the end of the day, it's going to be probably, well, not probably, it's going to be cheaper to do the first right in the first time, and let the professionals do it. What else? Yeah, like I said, all of those professionals have to be in place before you start, and don't be shy, don't be afraid to talk to people. They're not going to charge you, right at the bat. They charge you for the work, and most likely the work will cost you less than, the savings you get out of it. Am I right, Randy?
I do have a question.
Yeah.
So you have a property. I've noticed if you're looking at a house in Hamilton, the good old days, you could rent a house and you get the whole house, right? Now you're renting a house and they say, oh, that only includes, the first floor and the second floor. But then you notice, wait, they've got a basement and they also have a top floor. And you're thinking, is that legal? How difficult is it to convert a home into a triplex here in like Ontario?
Well, every municipality has different rules for sure. And Randy,
are they all legal? Are they all legal dwellings?
Likely not.
Okay.
Unless they're very old and they've been grandfathered, you really have to be careful. The city of Hamilton and many other cities are really starting to clamp down. It is based on complaints. So if you keep your neighbors really, really happy, maybe they won't complain. But usually that's where it starts, is a neighbors calling the city and saying, hey, I noticed, 2 or 3 families living next door to me. What is this property supposed to be? The city looks at it and finds out it's a single family, and then the city comes and knock it. So one of the things I recommend as a property manager is, if you are buying a property that's not legal, number one, know what it is that you're buying. And number two, buy it based on what it is. Yuriy will agree with this. If it's a duplex, but it's running 4 units, you have to look at it in the sense of not if, but when is the city going to come a knocking? And when they come a knocking, what's your plan, right? What are you going to do? If you're going to end up taking those 4 units and turn them into 2 bigger units and generate a little bit more rent out of those 2 units versus, 1 bigger unit, right? But in the end, your positive, your numbers, your revenue, your income is going to be going down because you've got 2 units now making a little bit more as opposed to 4 units. You have to do all your numbers based on that. You have to do all your numbers based on what it is I'm legally buying, and then proceed from there. We do a lot of single to 2 family conversions, and we actually help investors. We can deal with the city in terms of zoning, committee of adjustments, getting the permit. So we do all of that work for our clients if they want to do 1 to 2. What I normally recommend with clients is to go from 2 to 3. Like going from 1 to 2, the cost from the city of Hamilton is $895. If you have to go to committee of adjustments, another $2,000. But if you don't have to do that, the cost for the permit, the cost for the process is $895. If you want to go from 2 to 3, that costs, all of a sudden you're dealing with parkland fees and GO Transit fees and bus service fees, and you're normally looking at a cost of about $20,000 to $30,000 just to the city. Then you got to look at all your architectural work, Usually when you're going from 2 to 3, it's $40,000 to $50,000 is what your cost is going to be. So I say that, we normally recommend go from 1 to 2. Don't even bother trying to go from 2 to 3.
Wow, that's where investing in the United States for a triplex sounds pretty good.
Yeah. Yeah.
I mean, wow.
Yeah, well, again, with all that being said, if you looking in the area like by Mohawk College or McMaster, so every single house there is rented for students, right? So nobody's gonna, again, I'd like to kind of be more on a cautious side, but like I said, in reality is in those neighborhoods, nobody's gonna call on you because they're in the same situation. So if you see 2 houses rented on both sides, rented to students, you might be okay. But that again might be, right? But the other thing is I wanted to point out as well, just to quickly, tenants. When you gotta choose your tenants extremely wisely. Like, they should be good like you, Ivan. I don't mean.
I play a lot of loud music.
I don't mean the looks. I just.
You're good.
So, on a serious note, when you choose the tenant, you gotta look at the not just the where they work and the some guys come in and with a suit and tie and everything else, and they have the job and everything else, and they looking for rent in $4,000 range, and all of a sudden they put you 2 month first and last month of rent and deposit, and that's it. That's all you're getting, and it takes you 6 months to evict them. I mean, I've seen those, and Randy probably have seen those horror stories as well. But you got to look at their kind of credit worthiness and do as much as possible of the internet research, there's Facebook and everything else, and look in their car, and to the point where you want to probably go, if you're thinking about investing, go to their existing house where they live and knock on their door and say, hey, here's a paper I forgot to give you, something like that, right? That you need to sign, and just to see where they live, how they live, what they do, and and talk. And again, I wouldn't talk to their landlord, existing landlord. I would talk to the landlord prior to that, because that landlord will be most likely will tell you what happened. This landlord, if they want them out, they'll tell you all the wonderful things that the great tenant, just get them out, So that's just.
I have a question. So because of the costs in Hamilton, like Ontario, I know Araceli recommends that 1% of your investment, which she acknowledges it in you, Yuriy, as well. It's pretty hard to do in Ontario. What do you recommend? What is the rate of return on your investment in Ontario? What is the recommended number?
I always go by cash flow. Well, whether it's 1% or 2% or 0.5%, whatever, it's to me, as long as it cash flows. I come from banking background. I look at how much money I can get from bank, and they look at the positive cash flow, right? If I can't get the financing, conventional financing, that is probably not cash flowing. However, with all that being said, let's say you're buying this, for example, it depends on the type of investment you want to do. Because if you buy in the property for $800,000, that's really worth $1 million, and then you do some more renovations and you flip it and you cash in 150 grand, there's nothing wrong with that picture. So it depends on the strategy, depends on what it is. But if you really want to rent, it has to cash flow. But keep in mind, there's also on top of that, there is a mortgage pay down. So you have a little bit extra coming your ways in a sense. In 20 years, your mortgage will be paid out, or 25, something like that. So that's another thing. I don't look at the appreciation because it can go up and it can go down as well. But look at the, mostly at the cash flow and the principal pay down.
Okay.
But again, with the like Randy and Araceli pointed out, with the one unit, you have it's a lot riskier business than you would have with 2 units or 3 units, because obviously you losing one tenant, you still have 2 tenants that pretty much will cover your cash flow. The third tenant or second tenant is a bonus kind of thing. So at least you have cash flow and you don't have to put up your money. Well, if you have to put up $100 to $200 on a monthly basis for a couple of months, that's okay. But if you don't have any tenants and you have to subsidize $1,500 a month, that's a different story.
Yeah, because the reason I'm asking is, as you're aware, I've invested in that pre-built condo. And now I guess you've got occupancy, so I'll have occupancy in September.
$597 per square foot, by the way.
Yeah.
Yeah.
Wish you could get a 600 square foot condo nowadays, eh?
Well, Catherine, in Ontario, if you're buying in Ontario, it's fantastic because the appreciation, you're not going to get the appreciation anywhere else the way that we have it here. However, you have to look at, are you able to support that? If you have a large down payment, let's say you got an inheritance or something, and you buy the property for, let's say, 50%, and you have only 50% mortgage, that might work. And that might give you some positive cash flow in the meantime, and then leave it there so the money can keep appreciating over time. But if people are trying to get in with the minimum investment, then it's a little harder to get either financing and also to have cash flow positive. So.
Yeah, because being self-employed is like a kiss of death for a mortgage, right?
And another point, I think I brought it up with this group before. Once you have your whet your appetite or get into real estate investing, you can go to commercial. And while it's it's crazy, this scary beast all of a sudden, but it's not. It's same principles apply, and you actually get you looked at as a business, not a person, but it's a different conversation for a different day.
I have a question. How do banks in Canada view your land ownership or your property ownership in the United States?
In what sense?
In the sense of buying power here, do they look at that and go, "Oh, you have this asset here, so therefore, you're going to be able to use that as collateral or whatever it is"?
Well, no, you cannot use the collateral in the U.S. with Canada. So they will not lend you. Like if you're thinking about getting a mortgage for a property in the U.S., you cannot do that. They will only lend you within the country. So that's kind of the rules. What you have to do is you do have to report if you have over $100,000 worth of property abroad, anywhere, not only in the U.S., but in your taxes. That is a question. So you have to answer that.
But do they look at that and say, you have an asset here, you bought it cash.
Mm-hmm.
That asset, we will lend you here for something else?
The way that you could do that is if you do have a large line of credit, if you have lots of equity, you can use that line of credit to buy in the U.S. But you cannot use the collateral from the property in the U.S. to get a mortgage in Canada. So.
Wow. Okay. And which is the better investment? I mean, there's a perception that if you're going to invest in real estate, you should invest in a condo. Is it a better investment, long term, or is it a better investment to buy an actual house?
I am going to let Yuriy answer that because I'm not, very fond of condos, but.
Okay.
I'll second that one. The only it's whichever you feel comfortable with. For my clients, for example, I would never recommend to buy a condo because we can't buy anything more expensive, like we were just being priced out. I only would recommend if it's a lifetime, a life choice, basically. They don't want to cut the grass, they don't want to do this, they don't want to do that. Like no property management, no offense, Randy. That's the only time I was like, you wanna easy life kind of thing, fine, go that. But I'm against the condo fees. Basically, you're paying huge condo fees, and especially nowadays, and they're not they don't get as much appreciation as the single homes. However, some people in Toronto would disagree with me because there was a huge gap between single homes and condos. The condos just shut up crazy, 20-30%. But that's a temporary. That's a not a rule. Basically, more of an exception. So from that perspective. But in general, like I said, the condo is a life choice, basically. So I don't know if that answers your question or.
Yeah, if I can add something, I
Yes.
think over time, I agree with you, Yuriy, like the condos do not appreciate as much. And the one thing that you cannot control is the condo fees. Condo fees after, at the beginning, they might seem low, but as the building gets older, the property, the maintenance fee goes up really quickly. I do know people that they have condos that they're 10, 15 years old, that they actually pay more for condo fees than what they actually pay for the mortgage.
Yeah.
And it's harder to sell because now if you're trying to sell it, how can you justify that you're going to be paying almost another mortgage payment for the condo fees? So that is a difficult thing to control.
Yeah.
Wow.
Well,
You're renting with $500,000 down, right?
Yeah. Again, on that note, I'm against the investing in condos. However, I'm investing in pre-construction condo, which is slightly different. But you got to be careful too if you want to unload in a sense or sell before it's closing. You're gonna be in for a surprise. You have all kinds of taxes that you have to pay. And your capital gains, your HSTs, you don't get the refund, so it's all adds up. Ideally, you want to actually take your possession, get the mortgage, and after a year's time, if you can't carry it or it doesn't cash flow, then sell it. If it's still cash flows, and that now in Toronto they're not allowing Airbnbs. I think they're working on it, but if they don't allow Airbnbs, then I'm probably not going to cash flow most of it. So it might be an influx of some condos on the market. But that's like I said, it's a comfort zone, right? I know tons of people that all they do is pre-construction condos, boom, 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 and then they basically rotate and it works. But then again.
Sorry, Yuriy. Just adding to Yuri's point, it really, I do a lot of mentoring with real estate investors. And one of the first things that I do is, what's your why? Right? Why is it that you're wanting to get into real estate investing? And depending on the why, they may want that condo, right? That turnkey product that they don't have to worry about, they don't have to touch, they don't have to do the grass, they don't have to worry about any repairs because it's all brand new. So that's can be a good strategy for some people. It really comes down to what is your why. For me and the wife, when we first got started, and this is going to sound crazy, but we started a long time ago. And we started at a time when it was pretty difficult to sell a house. A house was sitting on the market for 4, 5, 6 months. The first couple that we bought were condos because the wife wanted the ability to sell quickly if we needed to. If we had a daughter that was about to go into college, bunch of other things going on, and if we needed that cash, we needed it quickly. So it made her feel comfortable. That's how we got started. And then once she got comfortable with it, then it became easier to start buying. Now Yuriy can tell you the properties that we buy, most investors are running away from them. One of the first properties I bought on JV was a crack house. So we actually had, on the 23rd of the month, we had a lineup down the street of people that were using our address to get their checks from the government. And one of our first tenants, they told us, it's like, honest to God, it's a lineup all the way down the street. So yeah, that's one of the horror stories, but it worked out well in the end.
JV is joint venture, right?
Joint venture, yes. So another person came in with the money, and we came in with the expertise, the knowledge and expertise to make it all work.
Yeah, that's another way of getting into investing and learning, valuable lessons from someone that knows stuff, and then getting into it yourself. That's one way of doing it. And I'm gonna extend into commercial, for example, if you buy in a sixplex, for example, and in reality here is like almost $200,000 per door, which is crazy, but so you're looking at the investment of $1.2 million at six units. In majority of cases, doesn't cash flow. And although on a profit loss sheet, they'll tell you, oh yeah, this is potential, this and this and that. The rent is laughing. But there's a potential you can charge more rent. Like, can I take a vacant possession? No. Well, then why would I be paying for something that I will be doing down the road? But anyway, it's not the point. The point is, for let's say, so for the $1.2 million on a and some financial institutions do it on a residential side. It's 6 units, but it's kind of almost gray area. If you look in 7 units, it's commercial, right? In terms of financing. So I mean, again, I shouldn't say that because there's always some exceptions, right? But anyway, in general, so you're looking at 6 or 7 units, it's commercial, and you have to pay 25% down. So you're looking at on $1.2 million, almost $300,000, right? Or you want to go and buy a $3 million unit or $3 million property, and it's probably looking 150 or 120 to $150,000 per door, and then you're looking at a higher number of units. In terms of down payment, you can get it at the commercial side, but it's only at 15% down payment on a high rise, mid to high rise. So at that point, you're looking at 450 versus 300,000. So it's not a huge difference, but your income is going to be or cash return is going to be much better on those. And there is a myth there that you're on a commercial side, you're paying 6, 7, 8% on a first mortgage. It's not true. Like I can get around 3% mortgage rates for qualified buyer. Because and then everybody starts running like, oh, I'm going to get that. No, you're not, because if it's your first property, you have no experience, you're not going to get that. So there's there's few things that you need to know about commercial as well.
I have a question. Someone mentioned about rent to own. How does that? Where's the benefit of rent to own for the homeowner and the benefit of rent to own for the renter? How does that work?
Were you going to say something, Yuriy, or?
No.
No, okay. We do rent to own. So we offer that to our tenants. It's kind of a graduating out of the rental pool and into the ownership pool. So how does it work for the tenant? Well, it's advantageous for the tenant because they're basically, some of the money that they're spending on their rent is now going towards their ownership. The benefit to the client, to the owner, is that it's a nice facility. Like we do that with money partners, with joint venture partners. They're looking at probably a 15 to 20% return on their investment, and their investment has got a timeline. The expectation is that the tenant is going to buy this property within 3 years, on the 3-year mark. We always do 3 years because sometimes there's little hiccups, bumps in the road. We want to make sure that it happens. We want to make sure that we have 100% close ratio. 100% close ratio, the tenant ends up purchasing the property from us. If there's a problem, if there's a bump in the road, COVID-19 shows up as an example, and they just can't qualify for a mortgage right now, we've got the ability to extend it for 1 year. We've got the ability to extend it a second year. We want to make sure that within that 5-year mark, it's done. And our investors understand that. They know coming in, they've got a 20-25% return. They're going to get that for 3 years. It might go to 4, it might go to 5, but it will. They will see an end to it. And a lot of investors want to see that. At the end of the day, they want their money back, right? So that they can do it again somewhere else. But they do want their money back. They want to see an exit strategy.
So what is the
Ivan?
What is the actual close ratio?
Ours is 100%.
So 100% of the people that enter into the program to rent to
We're
own,
very particular.
tenant, they actually close, and they
close. Yeah,
that's amazing.
We're very particular. It's a very high bar that people have to get over in order to get into our program. Usually what it is, it's individuals that have the income, but for some reason they've messed up on their credit. And the first thing they have to do is they have to sit down with someone like Yuriy, a mortgage broker, to determine what they need to do to fix their credit. And together with Yuriy, they need to come up with a plan. This is what we're going to do, and this is how much time it's needed. And then Yuri's going to come to us and say, okay, if they stick to this plan, they can buy a property in 3 years, and they can buy a property for $600,000. Right? Then we take $600,000 and we scale that back, because we do expect the appreciation value to go to the owner. So we scale that back and we say, okay, you know what, based on, let's say 4% appreciation, you can qualify for a $500,000 property today. And they go shopping with Yuriy, the realtor. And Yuriy knows and understands our requirements in terms of a property. No swampland in Florida allowed, right? It's got to meet certain requirements so that if that tenant buyer isn't able to purchase, we can step in and either turn it over to a normal rental property or sell it. But you know, hoping all along that tenant buyer is going to be able to purchase at the end of the day.
Okay.
Randy, what is the option consideration that you have for any tenant buyer? Like the down payment?
We will do as low as 5.
Mm-hmm.
We prefer to see something in the $10,000 to $20,000 range. And that just factors into the equation of how much time do they need. Because at the end of the day, they're going to be closing on a $600,000 property. They may be a first-time buyer, so they're going to buy with 10% down. They need $60,000. The more you have now, the less you have to put into the pot every month, right? So if you're putting in $5,000 today, you got to put a lot more money in every month to get to that $60,000 than if you're putting $20,000 in.
Because that's $60,000 over your rent.
So we calculate rent a little bit differently. So you saw with Araceli her calculations, and I agree with what she was doing 100%. We're in repair and maintenance costs.
Mm.
When we look at a tenant buyer, we throw all of that out.
Mm-hmm.
Okay, there's no need for property management. They are this is their property, right? They have got 100% ownership in it. Even though they're renting today, they know that they're going to be buying that in a couple of years. They're 100% invested in that property. We don't need to have property management at all. We may be going there and seeing them once a year, twice a year, just to say, hi, how's it going? That's about it, right? So there's really no cost there. We don't have to deal with repair and maintenance because all the small stuff, they deal with themselves. The only thing we're going to deal with is if the furnace breaks down, we'll replace it because that's a big cost. If the roof fails, we'll replace it because that's a big cost. But we know what those costs are going in. Yuriy, when he, as a realtor, he's going to tell us, you know, the furnace is 2 years old. It's still on a warranty for 3 more years, right? The roof is brand new as of 3 years ago. There's not going to be any problems with that. So we know going in that there's really not going to be any repair and maintenance costs. Vacancy, same thing. We know that there's no vacancy costs. They're not going to leave the unit, right? And then we're stuck trying to find another one. They're going to be there until closing. So we take all of those costs and we throw it away. The only thing we really look at is what's the mortgage cost? That has to be covered. What's the property taxes? That has to be covered. And what's the insurance cost? That has to be covered. Then we add a bit of an inflationary value to it. So we might add 10%, right? And then that's what they pay every month for the next 3 years. Anything above and beyond that, that's going towards their down payment.
All right, I have one other question because somebody mentioned this as well. They said that the best properties are not on MLS.
It's correct,
Yuriy.
100%.
Then where do you find the best properties?
I can tell you where I can find my properties in the US. I do a lot of foreclosure and I do private sales. So, but yeah, the MLS, in some cases I do find good deals. It's a matter of negotiating. But that is in the US, especially if the property is not rehab. So I'm able to negotiate quite a bit. The MLS here is completely different. You get fair market value, sometimes more because obviously you need some room to negotiate if there is any negotiation. But I think that Yuriy, he's go knocks on doors and finds the properties. That's probably the best way.
Just knocking on doors.
Well, I mean, there's so many different ways. Like I said, if you're looking at the like you look for signs of distress. That's your first kind of clue, right? You're not taking care of yard, clutter, roof. I don't know. There's all kinds of things, right? But then again, talking to neighbors, talking to people you know, and they might be selling off the market, right? And you know, it's not. I mean, people think, oh, you're going to be taken advantage of. Like it really of people. It really depends. If somebody's up to wazoo in debt and they need to get out of it, it's either claiming the bankruptcy and or you getting out of the property and you get in a few $1,000 on top of it. You're still better. In a year's time, you have a good job. You can buy the house, buy the property, or you ruin your credit bureau for, well, they say 7 years, but it's not true because you get a discharge after a year and a half and then another year. So that's where that 3 years comes in, kind of thing, right? Where you can rebuild your credit score within 3 years and you can be on your feet again, but still 3 years versus maybe half a year or something like that, or you know, you start fresh and you learn your mistakes and you go on with your life, kind of thing. So it's not, who's to say, you know, whether it's you taking advantage or not. You come to the agreement with the person and done, right?
Well, you're filling up a need, right? Especially people that are really desperate. Sometimes what they do is they don't think that there's going to be this bad, and they keep let it go, and then they are getting to a point in that they don't have time to put it on the market. They don't have time to go to all of these things that they need to sell fairly quickly. And some people, they need the help. They might be older. They might not have anybody to help them out. They might have some, illnesses that they're not able to take care of the property. There's a lot of reasons why people are selling. And the thing is, you're there to help them out, right? Because otherwise they're going to lose the house anyway, and they're probably going to bruise their credit. May as well have something, and they get out with not impacting their credit.
I never thought about what Yuriy just said about look for signs of distress, unkept yards or whatever it is. I never thought of that. Randy, you were going to say?
I just want to throw another comment in there, kind of play devil's advocate, but I truly believe in the value of Yuriy, the value of a realtor. Every one of our properties we've purchased on MLS. One property have we purchased off of like as a pocket listing or outside of MLS. Everything's been on MLS.
Well, and again, to add to that, like I said, last month, it's very sporadic, but last month I found 15 units that are under market value. This month, it's only been 7 days. I have one. I found the one that kind of piqued my interest, but you never know. But with the problem with those, or the issue with those, or what's the right word? Well, you have to act quick. Meaning, if you thinking about it for 2 days, too late. It comes when I on my MLS, on my system, when I see 0 on days on the market, that's when you have to put the offer in.
Mm-hmm.
On a day 0, on a day 0, and preferably at the full asking price and no conditions. Then you get the property. But that you have to prepare for that. Like, for example, right now I'm looking for the client for the property, and we can't buy the property because they're looking under $400,000, and that's the max of their budget. We can't go any higher than that, and every time we go into the bidding war, 10-15 property offers. So what I did, basically, I went to the financial institution that I know very well, and I said, you know what, we're going to do this different way, because normally those properties will come in and say, well, we're going to hold the offers on let's say Friday.
Right.
So I take that property, I send it over to the financial institution and say, go, here's their financial information. Here's the property. Can you do it? Can you do this? And before we have to put an offer, we know if it's going to be approved or not. So because there's no other way. Yeah. And I put offers in for $15,000 more than any offers came in, and they still chose the one that didn't have the conditions.
Wow, amazing. Well, listen, guys, we're almost out of time. So if there are any other questions, this is a good time to ask. Okay, thank you very, very, very much.
Thank you. That was amazing.
I've learned a lot. I've got some comments here from folks that indicated that, like Sandra said, that she's learned a lot here. Very good information. Thank you very much. We should do this again. So I really appreciate it. I've learned a lot, and I thought I knew everything. But
that 2 hours don't help,
Yeah. But I'm really shocked at the prices that Araceli is mentioning in Ohio. That you can buy a house for $100,000. Amazing. Oh, you're muted.
Right now for property, we recommend about 125. Prices are starting to go up, but it's still very good cash flow. Remember, this is US dollars, so it's a little bit higher than that if you convert them in Canadian. But it's still the price point. It's quite different than what we have here. So,
Araceli, I have a question. Do you come across portfolios?
Yes, yeah. Oh yeah, we do. So it depends. The same. It depends on what is your strategy, right? Some people have 10 units. They have a building. It depends. Like, we run into many different things. So.
And what about commercial?
We haven't gone into commercial yet. So we're just right now purely residential.
I have friends in the Pittsburgh area, and they bought both their sons' houses, foreclosures. I think the expensive one was $24,000. One was like 16. They've literally stripped the houses back to the bones, put maybe 40,000 into them, and then they remortgaged the properties for their kids. So they got their money back out. The kids have mortgages, but when I say mortgages, their mortgage payments like $300 a month. They get like 40-year mortgages down there. They literally pay more monthly payment for a car than they do for their mortgage. And you know, some of those houses were reassessed. The one of them was like, I think when they reassessed, it was like $90,000. That was the one that they bought for 16,000. And so yeah, I know there's a lot of great opportunities down in the States if you find the right neighborhoods.
That's right. The only thing that I could tell you is that cheap, that does not mean a good deal. So you really need to know the area on where you're buying, because we have found we can buy properties for $2,000, but there's nothing you can do in there. That is a really bad area. As soon as you refurbish the property, either you get a really bad tenant that is not going to work out, or the property is not going to be, it's going to be a lot lower than what you put in for it. So it doesn't really make sense. So you really need to know the areas. There is a ton of opportunity in the States, but as long as you know the area, you know what is happening there, what is the gentrification and so on. So
yeah, they've been buying houses within their own neighborhood, so they know the area well.
Exactly.
And
so if they know the area, it's perfect. So
they live there, so yeah, they know what the ups and downs are in the area.
Yeah. So listen, folks, I want to wrap it up because we're out of time. But Araceli's information is in the chat window. So if you don't have it, please grab that information. Reach out to her because she has all kinds of knowledge and information on this stuff. Everybody should know Yuriy Nesvitt. Yuriy and Araceli are both members of This Great City. So if you don't have their information, just go to thisgreatcity.com and just look up, just punch in their names in the search, and their information will come up. Please do reach out to them because they're phenomenal wealths of information. Also, I want to thank Randy also for being a great source of information. We didn't even touch on tiny homes. You know, we'll have to come back and do that again another time. So thank you all very much. Thanks. All right, everybody.
Thank you.
bye.
Thanks,
Have a
Ivan.
week, everybody.
You too.
Everyone.